The latest inflation data shows the battle to tame prices is far from over. The official monthly CPI has spiked in the 12 months to May from 3.6% in April to a 6-month high of 4%, raising the chance of a rate hike. The biggest price rises were for housing, rents and new builds, food and non-alcoholic beverages, transport and alcohol and tobacco. And after weakening last month, power bills surged 6.5% in May as energy bill relief ran out. When you strip out volatile items, the underlying rate dropped from 4.1% to 4% in the period. The RBA has lifted the cash rate 13 times since May 2022 to 4.35% to try to get inflation back to its target range of 2 to 3%. The RBA will now be looking to the quarterly inflation data out at the end of July for a more comprehensive picture ahead of its August rates meeting. Phil O'Donoghue is the chief economist at Deutsche Bank, and he's changed his rate outlook forecast based on the data. Phil O'Donoghue, welcome. You think the RBA will now hike in August. Can you run us through why?
Yeah, look, I think it's very likely that the RBA is going to have to hike here. You mentioned the headline inflation rate. The RBA's preferred measure of underlying inflation, which takes out those volatile measures, which do move around a bit, things like electricity, that rose to 4.4% year-ended in May. If I look across the G10, Australia is the only country where underlying inflation has risen since December. We've now risen by 0.4 percentage points. The average across the other 9 members of the G10 is down by 0.9. Inflation is going the wrong way. It's accelerating here. I think the evidence overwhelmingly is that despite those 13 rate hikes, the RBA actually hasn't hiked enough, and they're going to have to hike again.
So that would take the cash rate to 4.6% in August. It seems like the RBA has a pretty high bar to raise rates. Michelle Bullock has been saying she's not going to rule anything in or out. Do you think it has a choice now?
Yeah, look, you're absolutely right. I think the RBA is very reluctant to hike. They are conscious of the pressure that rising interest rates have on cash flows in Australia. We have one of the most powerful cash flow transmission mechanisms here in Australia compared to other countries because our mortgages tee off the cash rate. That said, unfortunately, the evidence overwhelmingly is that the economy is still too strong. The consumption is still too strong. Even if we look at nominal house prices, we are at record highs across the nation. So despite that very acute pressure on cash flows for a lot of households, the evidence is, unfortunately, that that's being offset by strength elsewhere, and I think that's going to mean tighter policy in the very near future.
And what do you make of the fact that inflation has been ticking higher since March on the monthly read, and we haven't seen the stage 3 tax cuts hit the economy yet?
Yeah, look, and that's just another factor for the RBA to have to consider. We know that there will be an improvement in household cash flows on the back of those tax cuts. Given the starting point of accelerating inflation through the first half of this year, before we get those tax cuts, I think the board would be right to think, well, you know, we're going to be giving households more cash in the second half of the year. We're already seeing inflation rising. What's an extra an additional boost of cash? What's that going to do to household demand? So, unfortunately, put all that in the mix. I think it all points one way for interest rates, and unfortunately, that is higher.
Well, the monthly CPI indicator tends to be a bit noisier than the quarterly number, which is more comprehensive. We get that on the 31st of July. Could things change then? Yeah,
look, certainly that is an important point. The RBA will look much more closely at the quarterly inflation numbers that are released, as you say, on the 31st of July. That is the full suite of prices, price updates, so that will matter more. That CPI print comes out before the next RBA meeting, so that will be crucial. That said, we do have enough information. You know, the monthly CPI is a bit more volatile, but it is a subset of that quarterly numbers. And I think that we know, given that we've seen throughout this, the first half of this year, but certainly over the last couple of months, I think there is enough evidence there to suggest that the likelihood of a softer print for Q2 is very, very low now. I think inflation is likely to be above the RBA's forecast, and that unfortunately is going to be, I think, the catalyst for a hike.
And of course, when we're talking about the economy and the impact of interest rates, we're talking on aggregate. The pain is being felt disproportionately. It's a blunt tool. Michelle Bullock has said recently that the narrow path is getting narrower. Is there a risk if rates go up too high, we'll end up on the recession side of that path?
Yeah, look, there is always that risk. I would argue that, as is always the case for the RBA, it's about balancing the risks. My sense is that the recession that would follow if inflation isn't returned to target would be deeper. It would mean much higher unemployment, a much larger loss, if you like, in aggregate welfare than if we, have to push the economy a little bit tighter, that we have to push demand a little bit weaker in the near term. That's the challenge in front of the RBA. We can't see the future, of course, clearly, but weighing up those costs, I think we need to expect tighter conditions over the second half of this year. We can perhaps look forward to rates falling next year, but tighter conditions now, softer demand for the next 6 or so months as a result of that, and that will prevent a much deeper, much more damaging recession that could extend for 4 or 5 years if inflation becomes untethered from the target, and that just makes the RBA's job harder, of price stability job even harder in the medium term.
Okay, so very quickly, you think a hike in August. What's the peak cash rate, and then when will we see cuts?
Look, I think we should expect just one more hike. I think 25 basis point hike at the August meeting would take us up to 4.6%. I think that will be enough. We are seeing signs of demand slowing, so I think one more will be one and done. And I think we should expect rate cuts second quarter of next year if we do indeed see a hike in August of this year.
Phil O'Donoghue, I appreciate your time. Thank you.
Thanks very much.